Sarah refinances her mortgage the moment rates drop 0.5%. Her neighbor Tom gets offered the exact same deal and says no. 2 years later, Sarah has lost money. Tom hasn't spent $1 and he's already ahead. The bank never tells you the number that decides which one of them made the right call. Today, you're going to learn it, and you're going to be able to run it on your own mortgage in about 90 seconds. Let's set the table fairly. Sarah and Tom both bought identical houses 3 years ago for $400,000. Both put 20% down, both locked in a 30-year mortgage at 6.75%. Both owe roughly $310,000 today. Rates drop. Their lender calls both of them with the same offer. Refinance into a new 30-year loan at 6.25%, half a point lower. On the phone, it sounds like free money. Sarah says yes immediately. Tom asks one question first. What does this actually cost me? That question is the entire video.
Here's what nobody puts on the postcard that shows up in your mailbox. A refinance is not free. Closing costs on a refi typically run 2 to 6% of the loan amount. Appraisal fees, origination fees, title insurance, recording fees, sometimes points you pay up front to buy the rate down further. On Sarah's $310,000 balance, her lender quotes her $7,750 in closing costs. She rolls it into the new loan because she doesn't want to pay cash today. It feels free? It is not free. It's a debt she's now paying interest on for the next 30 years. So here's the number the bank will never say out loud. Your break-even point. It's the exact month where your monthly savings finally catch up to what you paid to get them. Below that month, you're underwater. Above it, you're actually ahead. The math is almost embarrassingly simple once you see it. Take what you paid in closing costs, divide it by your monthly savings. That's your break-even in months.
Sarah's old payment, principal and interest, was $2,011 a month. Her new rate drops that to $1,908. That's $103 a month in savings. Feels good. But she paid $7,750 to get there. $7,750 divided by 103 is 75 months. That's 6 years and 3 months before she has actually made back what she spent. Anything that happens before month 75, she sells, she refinances again, rates drop further and she wants to redo it, and she has lost money on this decision. Not broken even. Lost money. Every month before 75 is a month she's paying down a debt she took on voluntarily to save money she hasn't actually banked yet. Tom runs the same math on his identical offer and gets the same 75-month break-even. But Tom knows something Sarah didn't ask. He's planning to relocate for work in 4 years. 4 years is 48 months. He would hit month 48 still $2,861 in the hole, and then he'd sell the house and eat that loss for nothing. Tom declines the refinance, not because the rate was bad, because his timeline didn't clear the break-even line.
This is the entire decision, and almost nobody frames it this way. It is never, is the new rate lower? It is always, will I still own this house past my break-even month? A slightly lower rate on a house you're about to sell is a guaranteed loss dressed up as a good deal. Now, let's make it worse, because there's a second number stacked on top of the first one that almost nobody accounts for: the reset. Sarah's original mortgage was 3 years into a 30-year term. She had 27 years left. Her new refinance is a fresh 30-year loan. She just added 3 years back onto her mortgage. Even though her monthly payment dropped, she is now scheduled to be in debt 3 years longer than she was yesterday. If you run the full amortization, not just the monthly payment, the total interest paid over the full life of both loans, Sarah's original path was set to cost her roughly $407,000 in total interest over the remaining 27 years. Her new refinance loan, even at the lower rate, costs her approximately $389,000 in interest, but stretched over 30 years, starting from today, meaning she pays interest 3 years longer than her original schedule required. Some of that savings isn't savings at all. It's the same debt, repackaged, with the finish line quietly moved further away.
The fix for this one is almost free.
When you refinance, you can choose to keep making your old, higher payment on the new, lower rate loan. Same monthly cash outflow you were already used to, but now more of every dollar goes to principal instead of interest because the rate dropped. Do that, and Sarah doesn't just avoid resetting her clock. She pays the loan off faster than her original schedule while banking the exact same rate improvement. Nobody at the bank offers to explain this. The lower minimum payment is the sales pitch. What you actually do with that lower minimum is entirely up to you, and it's where almost all of the real value in a refinance is sitting, unclaimed. Let's talk about the part that makes this decision genuinely difficult, because so far this has sounded like refinancing is a trap. It isn't. It's a tool that's frequently mistimed.
Here's when the math clearly favors refinancing. If you can find a break-even point under 24 months, and you know you're not moving in the next 2 years, it's very hard to lose on that trade. If you're rolling a high-interest debt, credit cards, a HELOC at a punishing rate, into a cash-out refi at a mortgage rate a fraction of what you were paying, the math can work even with a longer break-even, because you're not comparing it to your old mortgage rate, you're comparing it to the 22% you were bleeding on a credit card. If you're switching out of an adjustable rate mortgage into a fixed rate before a scheduled reset, you're not really buying a rate, you're buying certainty, and that has value the break-even formula doesn't fully capture. And if your goal is to drop mortgage insurance because your equity has crossed 20%, that alone can justify a refinance, even with a mediocre break-even, because PMI is money you get zero asset in return for. Where it clearly does not favor you, anytime your timeline in the house is uncertain or short, anytime the rate improvement is small, under half a point, because closing costs eat the entire advantage before you've had time to enjoy it, and anytime you're refinancing purely
Because a lender cold called you with an offer that sounds good on the phone. Because the lender's incentive and your break-even point are two completely different numbers, and only one of them is on your side of the table. Here's the calculation, start to finish, so you can run it tonight on your own mortgage. Call your lender and get a real closing cost quote, not an estimate, the actual number. Subtract your new monthly payment from your current monthly payment. That's your monthly savings. Divide the closing costs by the monthly savings. That's your break-even in months. Then ask yourself one honest question. Will I still be in this house with this loan past that month? If yes, and the answer isn't close, refinancing likely makes sense. If the answer is no, or you're not sure, the postcard in your mailbox is not a deal. It's a bet you're being asked to make with someone else's money on someone else's timeline. Sarah didn't lose money because refinancing is bad. She lost money because she answered a phone call with a rate but never asked it a single question back. Tom got offered the exact same deal and walked away richer for saying no to it. Not because he's smarter about mortgages than Sarah, but because he ran one number before he signed anything. That number takes 90 seconds. Most people never spend it.
If you want to run this exact break-even calculation against your own mortgage, your own closing cost quote, and your own timeline instead of averages, that calculator's in the vault, along with the rest of the tools we build for these breakdowns. Links below. The next time a lower rate lands in your inbox, don't ask what your new payment would be. Ask what month you'd finally be ahead. Everything else is just marketing dressed up as math.